Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
So the standard deviation figure, when it's turned into realized volatility, is annualized. So we're taking that last 30 days of data, and we're making that representative for the past year. So now basically, we've got an apples-to-apples figure that no matter how many days till expiration we're talking about, or, what price the underlying asset is or anything, we can compare the volatility of one currency to that of another currency, or we can compare the volatility of a currency today to what the volatility of a currency used to be. Now, this is objective information based on numbers that we can really make some smart comparisons with. Let's explore realized volatility a little more closely. It's looking back, okay? It's backward looking back on actual prices of a currency. So really, we're not even talking about options here. Realized volatility exists even if there are no options. It's simply a mathematical measure of the past volatility of a stock or a currency or a future or what have you. Once again, it's an annualized figure, the annualized daily returns of an asset. And, I'm calling this realized volatility. You might hear people refer to this as historical volatility. That's probably an equally used synonymous term. Sometimes people call it statistical volatility or the underlying volatility. Now let's explore standard deviation just a little bit closer. Again, I want to give you the tools that you can use, not a bunch of fancy math that's going to confuse half the room here, but I want you to be able to take this stuff and trade off it and run with it and make sense of it. Standard deviation, often designated by that little shape right there, sigma, is a mathematical measure of the dispersion of data from a mean value over a certain period of time based on the closing prices, usually, almost always. Okay, so the greater the dispersion or the greater the volatility, the greater the standard deviation, and the lower the dispersion, the lower the standard deviation. And it's kind of based on this principle here. This is called a probability chart. And you look at this, and some of you will quickly and easily recognize this as what's referred to as a bell curve. This is basically the representation of price data that we're talking about. We could kind of split hairs just a little bit and say, well, maybe it's, log normally distributed, or have some other distribution that's slightly different from your symmetrical bell curve. But this is close enough for what we're talking about. Now, this is kind of important. A lot of people will look at currencies or stocks or whatever and say, well, hey, I'm bullish. I look at this as an upwardly trending thing or a downwardly trending asset. When we get into options, we need to kind of pry our brain a little bit away from that line of thinking and just kind of be a little open-minded briefly here for a second. We can think in our normal way when we're forecasting direction and such, but volatility has nothing to do with direction. For the volatility analysis portion here, we're not thinking about direction at all. We're thinking only about how big this dispersion of closing prices are. How big are, the daily changes in price? Maybe all the daily changes are in one direction. Maybe they're all in the other direction. Who knows? It doesn't matter. Maybe they're one day up, one day down, one day up, one day down. We care only about the volatility with complete disregard from direction. And then we find the standard deviation. And basically, standard deviation, as an aside, one of the things that it's commonly used for is if we take today's say, today's closing price of, say the British pound. We could look at that as the mean value. Okay, mean is an average, but, we're going to kind of substitute out today's closing price. And then if we were to take the standard deviation, and we'd say, okay, we'll take that percentage value that is the standard deviation and go up that percent from today's closing price, and then subsequently down 10%, or not 10%, but whatever percent that standard deviation represents, down from today's closing price, we would expect that 68% of all the data, of all future closing prices, given that same time constraint, would be between down one standard deviation and up one standard deviation. It's kind of an aside, a teeny bit relevant to what we're talking about now, becomes much more relevant in more advanced level discussions about this. But I wanted to throw it out there now just to, kind of give a little bit of background to exactly what it is we're talking about, and maybe that'll beget some questions later. We'll see. So, bullet point number 1, really important. Don't forget that, and, this does require you thinking about this just a little differently than probably you're used to. Realize volatility completely disregards direction. Could be up, could be down, could be sideways. Doesn't matter. It's volatility. And it's stated in percentage terms. And this is something that, although we're not going into the math here, it's something that if you're so inclined, you build a spreadsheet and you can calculate it yourself. It's highly labor intensive, especially when those calculations are already out there for you for free, probably through your online broker. Okay, so we kind of took this very, very intuitive process, or this intuitive concept, I guess I should say, and we quantified it. And, we got a little fancy with it. We took a very intuitive concept and made it complex, as complex as it has to be. We want to keep things as simple as possible, but it's got to be a little bit more complex to really understand exactly how we would use volatility numbers. But now we're moving on to a different concept in volatility. We're looking at volatility in a little bit different of a way. Now, how many times have you looked at, and this could be a stock, currency, a grain, could be a metal or anything, but how many times have you looked at two different assets that are trading around the same price? And then you looked at the front month at-the-money calls, both with the same strike price. And you notice that, wow, the calls on asset A are way more expensive than the calls on asset B. You ever seen this before? If you look at enough option chains and you're an active enough trader, you've noticed this. If you haven't, after this presentation, you're going to start noticing it a whole lot more. Now, the question is, though, why are these so much different? I mean, really, you know where these figures come from? Like, Greeks and volatility figures and theoretical values and stuff, they come from an option pricing model, which is just simply, we'll look at this more closely in a second, but it's just simply taking mathematical inputs into a model, and it spits out an output. It doesn't know what stock you're trading. It doesn't know what news is going in there or what the chart looks like. It's just a few simple numbers that calculates it. Now, so why should the options on one asset be so much more expensive than another asset? Well, it's because of the implied volatility.
Thank you for participating in this week's session. Please join us again next week. Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.